homeowners. Here we go. Welcome to Tampa Home Talk with your host, native Tampa real estate girl, Katrina Madewell, a full-time passionate, out-of-the-box thinker with love for homeownership kind of realtor with nearly 30 years of combined mortgage and real estate experience. Tune in every week at this time for expert advice on everything you need to know about home ownership, finance, maintaining great credit, building wealth, and making your everyday life better, and how you can be financially successful today and tomorrow. Remember, love where you live or let Katrina fix it. Now, here's your host of Tampa Home Talk, Katrina Madewell.
Well, good morning and welcome. This is Tampa Home Talk, and it's August 2024, August 9th to be exact. It's our second show in August of 2024, and today we're going to talk about 2024's real estate market and how this market is not like 2007. So for those of you that have been around, you may remember the peak of that market was 06. So December of 06 is where we're going up, 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 up. And then January of 07 is when we started dropping. And so that's what we're seeing right now.
So we don't want any Chicken Littles out there.
Well,
right?
we've seen these trends, right, in most of July. We've seen a lot of price reductions, really deep price reductions.
Improvements.
Well, you can call them what you want, but they're changes. And I think that's going to continue. There's a lot of talk about rates. Rates have improved a little bit from what I've seen. Hopefully we'll have Sarah Quickie on bottom of the hour to talk a little bit about that, even though the feds haven't actually made any change. We were talking about that before the show, that the bond market can literally affect what rates come out at daily. Lenders can get more than one price sheet for the day where rates move up and down. So it's pretty normal for that to happen in their world. And it's not like, the Fed set the rates and that's the rate till the next time they change it. It doesn't work like that. So in the real estate market, it very heavily follows the bond market, and that determines what the rate is for the day. And there's a bunch of other variables like credit score, how much you're putting down, the loan amount. There's a lot of variables in there.
Now, how quickly can you lock it in, right? Like if you lock it in today, you're probably 30 days, 45 days?
Well, you can lock it in whenever you want. Lenders get pricing on these sheets. A 15-day lock is going to be different from a 30-day lock. It's going to be different from a 45-day lock. It's going to be different from a 60-day lock.
Does the rate get worse as the locks get longer?
The pricing gets worse as the locks get longer, and it could affect the rate, if that makes sense.
Yeah. So like if you have the cash to close in 14 days, you're going to get the best rate.
So it's hard to explain. You almost have to be a lender to understand this, but there's kind of like a matrix. At least that used to be. Now it's all online, I'm sure.
Right.
But like when I was a lender, there would be like a sheet that they would print out, and it would show the rate on this column, and it would show if it was a 15-day, 30-day, 45-day, 60-day, and then sometimes they'll go 90. Most lenders are charging for that long of a lock. But essentially, that's when your rate lock expires, and then they would have different changes that you would have to look for. So the loan to value, the credit score, the loan amount. So that would change the base pricing. So they would have what they call par, which is at zero, and then like a negative number, which is basically what the lender would make. And then the other side are what people are familiar with, points, right? If they pay down points for a lower rate. And so your rates will be up and down vertically, and it'll start from, 6% and go to 8%, and theoretically you have prices that move in about 1/8%. So if you've ever heard the term like buy down or rate buy down, which is different from a temporary buy down, but anyway, you can do a permanent rate buy down, and that tells you how many points. They follow the matrix. But anyway, so what I was saying, if that makes sense, you might have a 30-day lock at par, and then it's a little, like the rate's the same for a 15-day, but if you go to a 60-day, it could get worse by 1/8%.
Okay.
If that makes sense.
It does.
Anyway, that's the best I can explain it. So let's jump into the market data. I'm going to introduce our guest. Mr. Mike Wasylik is back. It's been a minute since you've been in the house with us.
It's been a while.
When's the last time you were here? Has it been a couple years or like 5?
It's been like 5.
Okay.
Yeah, it's been a while.
2009.
Time flies when you're having fun. I think it's like a year or two ago, and then it's like 10, so it's like that.
Yeah, like I've been on the show for probably 8 years. Think about that.
We've been at Beasley for over 8.
I know.
So, yeah, it's been a while.
You go back to the archive books.
Right.
Yeah. So, look, I do want to talk about how this market is very different from '08, which was the bottom. The top was '06. And then, we had that slow climb back up. To jump into the market data, we're seeing what I've been saying for the last couple weeks. Remember, because I was like, I'm not sure if this little blip we're seeing the second week in July is temporary from people being on vacation or this is kind of permanent. And the numbers showing up every week and the stuff we're seeing every week on our listings show that this is the beginning of our shift. Like, this is truly the beginning of a little shift in the market. And so our new listings are coming in a little lower this week, coming in at 769. So that tells me that homeowners are sitting on these lower rates that they locked in a couple years ago. They're sitting on them. Compare that to last week when we were at 901, right? Price decreases are still off the chain. You look at price decreases. Last week it was 1654. This week we're coming in at 1439. And then your sold data, another important piece to pay attention to, coming in at 621, where last week we were at 976. I'm reading that right, Leo?
Yeah, I mean, there's this sharp, 20% decrease between last week and this week across the board, across in the news, the decreases, the solds, and the pendings. I mean, it's like...
Pendings, by the way, are coming in at 723.
Did we lose a date? Was there a holiday I was unaware of that the bankers all took off? Because this looks like we lost a full day of productivity.
I think this is what we're seeing that's showing up in the market. Because remember, we talk about Danielle, that's like that rear view mirror lens we have her on from what appraisers see. What we see on the real estate side is the front side that they have not yet seen, right? It's the front side of what you have not yet seen, Mike, but we see that based on the activity on our listings, the number of showings. All of those things are a future indicator of what's going to happen in the market, right? And how consistent is that week over week? Is it limited to one property or is it all of them? And we're seeing right now it's all of them have limited showings. People are electing for new construction. We're seeing a lot of that.
Now, do you think with this little bit of a dip in the rate that we might see a little bit more activity in the coming weeks?
I don't think it's going to be enough unless it's someone that was already planning to move here. We're still seeing relocations, just not at the mass number we were seeing before. I think the commission changes that are coming up on the 17th, which we're going to talk about in a couple of weeks. We're not ready to dive into that yet, but we are going to probably dedicate almost a whole show to it, even though we have our guests booked out for the next 6 weeks. We're going to spend ample time on that and what that means and how it's changing. I think the people that want to buy are buying. The people that are already in their home are kind of settling in. It's kind of like saddle up on this low rate that you have.
Right.
I think if buyers could take their rate with them, we would see a whole different market, but that's not the case.
Oh, I like that rate portability.
Yeah, I wish.
Where's our Republican senators to make that possible?
I mean, you would think, they've already allocated the money for a certain period of time. They already locked in and bought that money when it was that price. You would think they'd be able to take it for the remaining term, and they can't. But what you can see, if you have an FHA or a VA loan, is those are assumable, and those are different. And conventional loans are not.
Well, and conventional loans are harder to get, so why are the FHA and that?
It's the way they're built. I mean, these are government-backed loans. It's not my role. It's the way VA and FHA have set them up.
Wait, they're assumable. That means that someone else can buy your house and assume your rate?
Correct, and your loan. Yes, the remaining term.
Why am I just hearing about this now after 20 years in real estate?
It's not changed. We just haven't seen it because rates have been low, so there's been no reason for people to look for that. But now that the rates are higher than they have been, people were locking in at 2%, 3%, 4% compared to,
which is 7 right now, or 6.5.
I think Sarah said she's seen
on the news yesterday
high sixes, on some of them. And so essentially that it's a big difference. If you run those payments, they're huge. It's a big deal. And so the caveat to that.
Are people putting that in the MLS saying rate is assumable?
So here's the thing. I don't think there's enough education on that. You also want to have a professional, probably somebody like Mike involved, which if he's not brushed up on that, he'll probably want to get brushed up on that.
He just made a note to brush up.
That's a game changer. That is literally a game changer, though, in trying to sell a real estate.
Game changer.
Well, they're assumable. Here's the thing. You want that transfer of liability, right, which is where your attorneys can help you out. You want that transfer of liability to go from the seller to the new buyer, and they do offer that on an FHA and a VA loan. If it's a VA loan, your entitlement or a portion of it's going to be tied up as long as that loan is in play. That's another thing to just be aware of. FHA doesn't matter so much.
So question for that. So let's say you have an FHA loan on a house you bought in 2020, right? So you got a really, really good rate, and you're going to let the new buyers use that, but the house that you're selling is, a couple $100,000 more than what you bought it for.
That's it, my friend.
So are they getting 2 loans at that point?
No. Well, they could, maybe, theoretically,
but they're just able to use that rate.
The caveat to that is if they owe, let's say that house is $400,000, yet they have a mortgage for $250,000.
Right.
The caveat to that is if the buyer and the seller have negotiated a deal where they're selling that for $400,000, but they're assuming a loan for $250,000, that's the loan they're assuming. So they're either bringing the cash to pay the difference, which is not entirely off the table for some people.
Right.
Or theoretically, they could get a second mortgage behind it to buy, which might be a good. You'd have to do like a blended rate approach and have your lender look at that to see if that makes sense, but likely it does, And if you follow, for example, like the Dave Ramsey principles with the debt snowball, you could make that a debt snowball and just accelerate that second and pay it off quickly, which is going to have a higher rate.
So,
not a CPA, but last time I checked, mortgage interest is tax deductible.
So follow-up question to that. I don't want to get us too much into the weeds here, but let's say the person with the FHA has PMI, right? Which they probably do.
It's never going away. They change that after the crash. It's permanent.
Well, I guess my question is, if the person that assumes the loan, and they're putting, let's say on that example you had, they're putting $150,000 down, right? So they're putting, what's that, 30% of the 40% of the loan of the value. So do they still have to pay that PMI even though they?
So the question is, are they going to have mortgage insurance? And the answer is yes. Mortgage insurance is now permanent after the collapse. This wasn't always. This happened after the collapse. But mortgage insurance is permanent on FHA and VA has a guarantee fee, but FHA it's permanent for the life of the loan.
Do you know if that applies equally to loans taken out before the pandemic versus afterwards?
No, the ones before are not necessarily subject to that. Okay. So, not the pandemic. Sorry, let me go back. Pre-housing crash. You said pandemic. Sorry, I had a brain fart for a second there. Pre-housing crash. So I don't know when it changed. We'd have to do research on it, but somewhere between 2007 and 2008, I would say, was when that changed to where mortgage insurance was permanent for the life of the loan. Before that, it was not. But I think we're gonna see that, be on a bill and change in the future.
3% versus 7%,
and
it still doesn't matter.
Here's the
because
thing:
you're saving a ton of
the
money.
mortgage insurance premium on an FHA loan is substantially different or lower than the mortgage insurance premium on a conventional loan, and like with any other insurance carrier, everyone's insurance premiums went up, including mortgage insurance premiums, because this is insurance. It insures the lender against default. These premiums also went up after the crash because lenders had to have more risk. So looking at the stuff pre-housing crash, Mike, those very well may have a substantially lower mortgage insurance premium than you could even buy today.
And they might be grandfathered in then to the old where the mortgage insurance could go away if you have paid down the loan.
Correct. I think that could be an option.
But that's for older loans, not for newer loans.
Correct. Yeah, from whenever that change was. Yeah.
It's important to check the terms. Yeah.
It's not a loan thing. It's an insurance thing. So it'd be based on whenever that insurance premium was written, right? So how do you dive into that and find that? I don't know. It's probably a question for you.
And I have no control over the PMI rates, all right, folks? So you don't have to call me on that one.
This has been a fun conversation this morning, huh? Yeah. We don't talk about this very often. I guess this is where my background comes into play a little bit, knowing these little tiny things. But I'm Katrina Madewell. I'm your host. This is Tampa Home Talk. We're hanging out with Leo and Adam this morning, my co-host, and, of course, Mike Wasylik. He is a foreclosure defense attorney, debt defense attorney, helps you with the sticky mortgage, I'm in trouble stuff attorney. Make sense? Is that right? Did I get it right? Okay.
Exactly right.
All right. This is Tampa Home Talk. I gave your market update. I think we're going to have Sarah Cricky on at the bottom of the hour to talk about rates, and we're going to talk about how this market is completely different than 2008, in my opinion. Stick around. We'll be right back.
Welcome home. This is Leo K. with Barrel Engineering and Inspection, welcoming you back to Tampa Home Talk, where we're talking about the gloom and doom of the market.
It's not gloom and doom.
I love the voice, by the way.
Well, thank you.
Very calming.
I got to say that in a calming voice.
Yes.
I'm sorry if I'm a little distracted this morning. My cousin's in the hospital.
Oh, no.
Aww.
I'm sorry to hear that.
Yeah, he ended up putting 5 to 10 of those stupid plastic courses up in his nose. He might need surgery.
What?
At least the doctors say his condition is stable.
I am not about this story.
I was waiting for it to come.
He was checked out. We thought it was real for a minute. Oh, gosh. That is your dad joke.
That's the
of
one
morning.
I wanted to use last week, but I could just not get it in.
brought to you by Mr. Leo, Barrel Engineering Inspections. He's always good for a dad joke. I guess when people call your company and they want to book an inspection, do they get you for a dad joke?
No.
Just one off the fly?
No, I wish I could. That would be funny.
No, structural engineering though, you know, he's hands on with that, so you might get a joke there.
All right, so Mike, let's pivot this in a more productive direction here.
I'm not sure I can recover from this.
Actually.
Actually.
I know,
We'll see.
right?
We'll see.
There's always these low punches, and we're trying to figure out how to get up. But anyway, so I feel like this market is. I know that it's different than 2008. It just is. There was too many banks making loans they never should have made. We didn't see any of that. And you combine that with how fast and furious this market was and how much cash is infused into the market. People are going to hang on to properties if they can. If they can't, they're going to take their loss and move on. We're just not going to see the abrupt walkaways that we did before because people didn't have any cash infused into the deal back then. So I think the people now are educated. They're just like, okay, we're going to take this hit and keep going, or we could just going to rent it out, or what are we doing? Even the rents, we're seeing once these payments are settled with the higher insurance, with the adjusted tax bill, it's higher than people can rent it for. We're seeing an interesting little thing in the market. So that's where the modifications might really matter, Mike.
There's a lot of differences between the market then and the market now. And one of the big differences is that back in 2007, 2008, everyone was underwater.
Yes.
In other words, they owed more on their houses than their houses were worth. And we're seeing the exact opposite of that today, where values are much, much higher. So when someone gets in trouble, where in 2008 the strategy was buy as much time as possible, find all the flaws in the loan, and litigate the daylights out of it every way we possibly could.
So people can save cash because they got to move.
to help people save cash, save time, and then ultimately either modify or find some kind of graceful exit, which in that time was usually a short sale or some kind of agreed surrender to the bank. Here we're seeing a lot different solutions where because of many recent economic events, we are seeing more modifications are available quicker, and because people have equity and because people have shorter default times now than there were because the courts are less backlogged. So you're usually dealing with a smaller amount due, past due. So it's easier to modify. It's easier to sell and pocket equity. Like somebody who sells a house here in Florida and moves to, say, the Midwest might be able to find a house for find a house they can pay off with what they make from a sale.
Yeah, we're seeing that. We've become California, right? Where people have these big equity chunks and they're moving to other areas. It was a running joke with my sellers, but it's like, I think we're here. Granted, we're not as high, but I mean, we're seeing crazy stuff in California with major corporations moving out, right? And we're seeing that.
Well, we're not as high as California, but we're much higher to where we were compared to ourselves 10 years ago.
Yeah. Oh, yeah.
That's the main thing.
Double.
We've improved.
Yeah. I'd say we're double from where we were 10 years ago.
Yes. Yeah, my house is worth double what it was.
Yeah. So that's pretty accurate market depiction, not even knowing what house you live in.
Right. Yeah. It's pick a house anywhere in Pasco County and you'd probably be.
Yes.
You'd probably see
It doesn't even have to go back 10 years, you know?
Oh, yeah.
Like my house is 7 years old, and the person that bought it, the original owner that bought it, it's like more than double what it was 7 years ago.
Right.
You know, I mean, it's crazy.
Yeah, and I think it's here to stay. We're in for a little market normal correction right now. Mm-hmm. If I had to put a number on that, I'd say 20-ish%, maybe a little more, maybe a little less, depending on the area and the neighborhood and how desirable it is for people and, you know, the affluency of that area. There's a lot of factors that play into that. We are seeing a lot of people move here largely because of insurance and the wages not keeping up and relocate to other states like South Carolina, Alabama. Those are two exit states
I've seen quite a few. North Carolina even. Seen a lot of people go there.
Taxes, though. You still see North Carolina?
I see a few, yeah. But those are people might be a little bit more towards the end of their career path. So it might have been I'm just going to retire 5 years earlier than I would have or something like that.
So these middle-aged working families that have a solid 10 to 20 years left to work, at least, maybe more, we're seeing a big migration pattern to South Carolina and Alabama. Those are the states we're seeing.
And if you're downsizing, empty nester, you know, that obviously opens up your options too. So.
Yeah, some of them still have kids, older kids, still working families. I mean, one of them I had multiple transactions with. he still is a teacher. She's a nurse, but literally just priced out, lived on the river up north, and just between the flood insurance, the homeowners insurance, the taxes, everything just going up, they just were priced out. Everything was just so much more expensive.
Well, if you're literally on the river, you're probably looking at $1,000 a month between home and flood.
Yeah, I mean,
for not a very large house. It's not like you're living in some mansion where you're like expecting to pay $12,000 a year in insurance. You might be in a $300,000 house, which isn't that big these days.
So, and I think the legislators really have to get a handle on what are we going to do to help homeowners insurance costs, and the spike in taxes I see is not really right. So I'll see like these lower tax bills, and then if someone's been in their home for a long time and they move, I mean, it can more than double. Yeah. And I think that surprised a lot of people that have purchased once they reset.
I see some of those where someone buys a home and then they're surprised because the tax rate adjusts because it's been capped, for so long, and it pops up to fair market value, and suddenly they're paying 3 or 4 times the taxes they thought they were going to pay, and suddenly that puts them beyond where they can afford the price of the home, and that's when they come
I think
to me.
it's something we have to fix from a legislative issue for sure. I really do. Because like we have the 3% for homeowners and then 10% for investors. I think they should pass that 10% rule to people when it's changing hands so they have a chance to at least adapt to that payment.
But we have portability. I mean, like if you are in Florida and you're moving from house to house, you can take that with you. So, I mean, there already is some relief for the homeowners themselves.
But I'm talking about
if you're not in the market yet, though.
Either brand new young homeowner, an out-of-state new homeowner here in Florida, that's the ones we're seeing with a big impact.
I think it also, it comes down to, and I try to do it myself, but I got to stay in my particular, occupational lane, yes. But, I think it also comes down to education from your lender and your realtor, explaining that, hey, what they're telling you right now is your monthly rate is the lowest it is going to be, right? Your taxes are going to go up. There's nothing you can do about that. Make sure you file homestead so it kind of caps where it is. And then I explained to the insurance for them. Once you get to year 2, you're going to be in the rears a little bit because they can't collect for more than what it is now.
Yeah.
And it's going to go up, so you're going to be paying the difference for it to go up plus the difference of what they're collecting for next year.
So I had a listing appointment this week. Super educated lady. She's a nurse practitioner, pregnant with their second child.
Oh, boy.
The husband earns money, but he's not like the primary breadwinner like she is. And the changes that they've seen in their payment due to the changes in taxes and insurance, and combine that with the fact that she's pregnant, she's lost her job, so now she's going to be not purchasing until after, some time after the baby comes. It's a really pinch for them, and they're feeling that crunch, and they want to sell, and they don't have the equity to sell.
Right.
Like they'd be lucky. They were going to lose everything they put in it. They'll be lucky to walk away at zero if they don't have to write a check. It's going to be interesting. So, that's heartbreaking when you're telling people that and they look at you like you're crazy because the market value is not as high as they paid for it at the end of 01, I think in that case, 01, 2022. But that was a tough market. People were still bidding up a lot in 21 and 22.
Right.
Even some at 23.
And if you didn't put 20% down, like that's the thing with the FHA stuff.
And
if you don't
a lot
put
of
the 20
them,
down,
if you remember, FHA and VA had a hard time competing in the market over the last couple of years, so it's mostly conventional loans that we saw.
Yeah.
What are you seeing? Who are some of the people that you're seeing right now, Mike, that are in trouble and need help? What's their situation? What's the story there?
It's people who have surprise increases in taxes and insurance. I mean, it's not usually taxes because of the homestead caps, but it's insurance. I do see. I don't represent a lot of investors, landlords, things like that. But I do see that those are a frequent flyer sometimes.
Yeah. So you're seeing insurance as a big culprit in it.
I mean, mine went up substantially this year, and I know that everybody else got that same notice in January that I did. So I can only imagine what other people are seeing.
One of them I saw said that they have to increase, like one of the biggest insurers said they have to increase like 93% in order to. Yeah, it was a big number. So, and then one of the things too, we were talking about it before the break, but I know Rick Scott put something out there proposing that the homeowner's insurance is deductible.
That'd be awesome.
That'd be a game changer.
I think it
That'd
would
be
help.
like portability of your FHA assumability.
If people spend the money right.
Correct.
Right? Like
Well,
if they take that and they apply it to their escrow. I don't know if they
Proposals are
will.
proposals. Getting it passed and signed into law is another thing.
Yeah.
That's a whole
Yeah.
whole-
In Florida, we're really feeling it. So we'll talk about this and a little bit more when we come back after the break. This is Tampa Home Talk. Stick around.
Well, welcome home. This is Tampa Home Talk. I'm Adam Talley with Talley Insurance. And before we dive into our insurance tip of the week, if you have any questions, you can call or text 813-377-2775. That's 813-377-2775. That's our off-air number. You can call or text 813-377-2775. If you
Just
can't-
because I didn't give it out.
Yes, yes. No, but you please call or text that number. Before we went to break, we were talking about insurance costs and everything going up. And what I've seen this year, right, is a lot more carriers are open. So in the past, say 21, 22, or mostly 22 and 23, we had a lot of carriers that were shut down for production. Right, so like you pretty much were citizens or bust for a couple years, or you were staying where you were. If you stayed where you were, you probably saw a lot of rate increases, right? The good news is we're being able to save a lot of people money on their renewal, right? Because your renewal, as you talked about, one carrier is going to go up potentially if they get approved, 93%.
Did you see that too?
I heard about it. I didn't read anything on it yet. I'd rather
That's
just not know until it's
feasible.
actually going to happen. It's not unheard of. We've seen rates double a couple times in the last couple years. Now, what I can tell you is about 7-8 years ago, we were writing policies for $500,000 homes that were $900. That takes a lot of $900 policies to pay for one total loss. So it truly was unsustainable. And when I go back and quote people, I go, hey, we had one carrier that was trying to get market share, and they were $900. Everybody else was $1,700. You're still not there yet 3 years later, right? Because we do have some carriers on new builds that, that price is $1,000, right? Which is really, really low.
And then is their goal to just jack that up a little bit every year? Is that what they do?
I don't think that's the goal because, if you jack it up too much, you lose retention. And in insurance, you make the money on having them there 3, 4, 5 years. You don't make it on the first year typically. So it's not the goal, but what I tell people is it's one particular carrier that has just a phenomenal brand new home rate, right? And I just tell them, I'm like, hey, this is $1,000. The next closest is $1,500.
Wow.
You're going to get probably a $200-$300 rate increase next year. Think of this as a big discount because next year you still won't be up to what the average was this year. So just prepare for it. I'm always happy to requote it, but realistically, you're still going to be in the best spot. So take it as a discount, not as they're jacking you up. They're just bringing you back to where maybe it should be.
Right.
Right. So it's just having that conversation, making sure they're aware of it. Similar to like we were talking about before, it's not my lane, but I do try to tell them, hey, next year, even if the rate stays exactly the same, year to year, you're going to have a little bit of an increase, right? And that's because the rating factors are changing.
Well, and everything's more expensive.
Right. So year over year, they should be increasing your dwelling limit to account for inflation. There's about 10 different coverages on your policy. They're calculated using a percentage of your dwelling limit, which means that you're going to have 10 other sublimits that are going to be increased as well because the percentages don't change. So not only are you getting more coverage next year, your house is sliding backwards through the rating scales, right? So your house is a year older, your roof is a year older, all this other stuff. So, you're going in two different directions rate-wise. So if the rate stays exactly the same, you're still going to have an increase year over year.
Have you seen any changes yet, Adam, in insurance options, like with the whole roof thing? Like, have you seen anything with people that are, maybe they're free and clear and they don't have a mortgage and they're looking for just a better option over self-insuring, right? Which is not having any insurance.
So we have a few carriers that'll do like DP1 policies.
What is that?
It's a very basic policy. It's more like a named perils policy than a special
You're
form.
still speaking Chinese. What does that mean?
Named perils says it only covers what is listed, right? Won't cover water unless it's listed. It won't cover a lot of other stuff.
Well, what's normally listed? So what's covered? How is that different? It's not making any sense.
What do you mean? It doesn't cover water.
Well,
right?
none of them cover water, do they?
They all cover water unless they list that
Unless
it's
it's rising?
excluded or limited.
Okay, so if you have a plumbing leak, it won't cover
Plumbing
it.
leak is water damage.
Okay.
Rising water is flood damage, which nobody
Definitely.
covers flood. But there's some policies like that. Another thing that I'm seeing is, so I'm working with a guy right now, and he has a 25-year-old tile roof.
Yeah.
Right?
That's what I'm talking about. That's the kind of stuff I'm asking about.
So with that, I have a carrier that will write them, and what they would do is it's going to be on an actual cash value basis.
So they'll depreciate the roof a ton.
Depreciate the roof.
That's
It
good.
should be replaced by now, but it's not.
And is his premium, is it in line? Is it good? Is it much better?
It would be it's a little less, but it'd be lateral for the most part price-wise. But what you're doing is, his renewal is in January. So the theory behind it is rewrite him in November, December before it's a 26-year-old roof.
So he doesn't get dropped.
The rate will be about the same now as for the new carrier, but the current carrier is probably going to be, instead of $7,000, it'll be $9,000.
I think they should
So
all
we can get
do
them down
that.
at
All the insurance
$6,500.
carriers should do those depreciated roof schedules. It would get rid of all this nonsense we've seen.
Yeah.
Where people are litigating for their roofs and making everyone's insurance go up.
And we have other carriers where, they'll do limited water damage, which helps. Anytime you see limited water damage, like certain carriers, it's after 20 years, some it's 30 years, some it's 40 years, but most carriers limit it to $10,000. I do have one carrier, which I think is fantastic. They'll do it at 5% of your dwelling limit. So
For the deductible?
No, for the water damage limit.
Okay.
So instead of $10,000, if you have a $500,000 house, you have $25,000, right? And that increases every year, so you're getting more coverage as the years go on, which is nice.
I think it's like with anything else, including some of the stuff we're seeing with healthcare. It's like shared risk, right? That's what we're seeing, which is not a bad thing. That shared risk helps keep everything affordable so that people don't have to come see you, Mike, because they're losing their home, right? Like that's when I think about it, that's what I think about. And I would like to see more of just stuff helping homeowners maintain what they have.
Well, and the other side of it too is, we're talking about more options. Rates are kind of leveling out from an insurance standpoint. If you did switch your insurance over the last couple of years, it probably was with Citizens. Well, now, you might be able to get something that is a similar rate, maybe not going down, but now you don't have to be with Citizens. You can get a little extra coverage. You have more options. There's things that, just are better with not being with Citizens. So even if it's lateral from a price standpoint, if you can not be with Citizens, which the less people are with Citizens, the more, financially stable and viable Citizens is. Because what happens if Citizens fails from a financial standpoint? All of us get surcharged. The Citizens policyholders will get surcharged first, and then they'll surcharge every single person that has a property policy in the state.
Without
home,
even being
auto,
on Citizens,
without even being on Citizens.
Yeah.
So do yourself and everybody else a favor. The less that you're on Citizens, the more options, or the better everybody else.
They're supposed to be the carrier of last resort.
Correct. Well, the problem is they were the last resort because they were, over the last couple of years, their policy might have been $2,000. Next closest, with chopping off all the arms and legs, was $4,000.
Yeah,
that is a last resort if you can save $200 a month.
Yeah,
right. And then you don't have to go see Mike.
I think that shared risk removing litigation is the option to keep it low. And it's like a catastrophic policy almost if your house burns down.
And some of them are putting in certain language like mandatory mediation, which means that they're going to mediate it between multiple parties regardless of the situation. A lot of them are going to a preferred contractor situation where you have to use their preferred contractors, but I view that as a benefit to you because the ones that are doing it are offering guarantees on the work for 2 to 3 years.
And they're vetted too.
And that keeps their cost, at a more stable position to where they can, do a better job on the actuarial standpoint, because it's really hard to do a good job there if one plumber for a normal job is $2,000. You go to the other plumber down the street, that's your buddy, it's $10,000. That's a big difference for the same leak, And now we have to have a restoration company that puts like 10 fans at $200 a day on these fans versus
you just need 2.
One that knows where it needs to be, and and on that preferred vendor thing, if you have a claim, right? I always tell people, if it's small, give me a call.
Yeah,
right?
Good one.
Let me talk with you first, because if you call the claims department, they're filing a claim.
You got a ding.
You have a ding. So call me first. If a tree goes through your roof, you don't have to call me. That is a claim. Just go ahead and call the carrier. I don't need to know about it. I'm not a claims adjuster. But on the small stuff, let's work on it together, because, I had a client where they had a plumbing leak. They called me. They had called a different restoration company first. Different restoration company was going to be $10,000. They have a $2,500 deductible. I sent them one of the preferred vendors for the carrier they're with, and I said, hey, this is a personal friend. Can you take a look at it? Surprisingly, it was only $2,000.
Yeah,
so it's below their
interesting.
deductible.
Yeah.
Saved them $500 and saved the carrier $7,500. So think about that. It's crazy out there.
Do they end up not making a claim then?
Of course.
Yeah.
They did
So
not
you
make a
save them
claim.
from that too.
That's
Save them from
ideal,
the large-
really.
Yeah, so
I'd say if anything happens, even a tree through your roof, get an estimate on what it's going to cost to fix it before you call the insurance company.
absolutely.
That's my opinion.
And you, as the insured, you have a responsibility to mitigate against further damage to the best of your ability.
So there you go. You're
right?
doing both.
Always take pictures and save receipts. Okay, if you're not sure if you want to file a claim, take pictures, save receipts. If it gets out of hand, now you have all the proof. It's time-stamped. We know when it happened. They can go back and open a claim and get you some money back.
Makes sense. So, Mike, who's a good connection for you? Tell me about some of your people that you've had that you're able to help. What kind of stuff are you seeing now, and who's a good match for you?
Sure. The people who are calling me now, at least for the mortgage-related stuff, are going to be people who are experiencing problems because their insurance has gone up or because their taxes have gone up by surprise. If they bought a property, they're not not portable rates. They're a first-time Florida homeowner.
Are you seeing job loss-related stuff? Just real quick to ask you that, because I'm seeing some stuff where the job market's a little unstable, and I'm just wondering if you're seeing that too.
So more ripple effects from the pandemic than any current. The economy right now doesn't seem to be affecting a lot of the people that I talk to.
Mm-hmm.
What I'm seeing is knock-on effects from back then, where people would get behind and then they just never caught up, and it finally snowballed to the point where they
Can't get out.
They fell in default and they entered a foreclosure, things like that. Weirdly enough, I'm seeing things that are servicing errors, like we talked about VA loans earlier,
Mm-hmm.
and you'd think that the lenders that are servicing VA loans, you'd think those would be held to the highest standards.
Mm-hmm.
But what I see is they actually make more mistakes.
What kind of stuff are you seeing when you say a servicing error? What does that look like?
So just incorrect billing statements is one that I've got a case where we've got a disabled veteran, and he just got he got completely wrong numbers out of a loan servicer. They told him he didn't have to pay for 3 months, and then when he didn't, they filed a foreclosure on him. So things like that, and then other VA issues because one of the things about the VA loan is they have very aggressive pro-borrower programs in place to try and prevent foreclosures. They want to
trying
make
to
sure
protect their veteran.
they're trying to protect the veterans, and they're also trying to protect the federal government's treasury,
Risk,
right?
yeah.
So and sometimes the servicers that handle that, they don't do them right. And to me, it's offensive because the people that are getting those veterans benefits are the ones that we should be giving the most care to, the most highest service. And I see the mistakes there, and they're just shocking, and to me they're unforgivable. So.
Yeah, it's real. I mean, I'll talk to you guys about a story that I can share on my own thing, and I'm in the business, and it's shocking that you would not think you'd see an error on a mortgage statement, but it happens. So
happens.
813-377-2775. That's our off-air number. We're hanging out with Mike Wasylik this week. He's an attorney that helps with these dicey little mortgage problems. If you have an issue, 813-377-2775. That's our off-air number. If you need some help and you need an attorney that can help you, he's good. 813-377-2775. We'll be right back. Stick around.
This is Leo Kane with Barrel Engineering and Inspection, rounding out the hour. I just don't think we have time for my listings today.
We're probably going to run out of time because I do want to hear some of the stories from the people that Mike works with. So you have some veterans, and then who else? What's an example of someone you've helped?
So again, like we were talking about, people who have had knock-on effects from the pandemics. We're seeing a lot of credit card cases too. Like people are going to pay their home mortgages as long as they possibly can, but they're less likely to. They're more likely to start defaulting on credit cards. So we see a lot of that first.
So what do you do for people that are in that situation?
So a lot of the times those companies are selling to debt collectors, and we deal with the debt collectors and the debt collection abuse, and there's lots of federal laws that regulate debt collectors that they violate all the time, and so we use that as leverage to solve those problems.
So let it go to default, let the collectors come, and then you just record everything and come see you?
I'm not going to say let it go to default, but
Right.
I say when,
It's
you,
bad
when, it, when,
advice.
it, when
Sometimes
it does
they
happen,
don't have a choice.
Right.
Like I think this economy we're
Exactly.
seeing, they don't
Gets
have
tight.
a choice.
Yeah.
They have to pick between food and housing or paying a credit card debt.
and when it does, if it's inevitable and it does, then there's sometimes a lot more leverage that can be had there, just because we've all heard horror stories about
Right.
debt collectors and the things they do, and so those are actually opportunities to resolve those problems in a very favorable way.
Mike, what are some of the examples you see when these debt collectors are breaking the rules and they're breaking the law? Like, what are some examples?
Gosh.
What are some stuff people could watch out for?
So one of the biggest abuses I see is credit reporting. So debt collectors, when they report onto credit reports, they're not allowed to make misstatements. They're not allowed to lie about credit. And so when people pull their credit reports and they see they have a collection and there's some false statement on there, that's a violation of federal law. And that's something that we can often use. If the debt's only a few $100s or a few $1,000s, that violation often can be many more thousands of dollars in the borrower's favor. So the debt collector owes them money instead of the other way around.
Got it.
And that's one of our favorite things to look for is any
my
misstatement
favorite, too.
anywhere. Yeah, any misstatement anywhere.
Well, there's so much of that. I don't think there's enough to even try to help people resolve stuff. You know, they just slam stuff on the credit report, medical. We see all kinds of stuff like this.
Well, and the biggest challenge is that most people have no idea what their rights are, and they have no idea. They're filled with misinformation by people who don't know what they're talking about, and they're not finding the right sources, and so they're doing the wrong things, or they're not doing anything at all. That's usually the worst problem, is they just ignore it and they don't do anything at all, and then they get into trouble, and then it's sometimes it can be too late to sort those things out. But if they are ready and educated at the right time and they get the right help, then oftentimes it's a lot easier to solve those problems than it would be if you just let it fester like a wound.
Yeah. Yeah, that makes sense. So would you say a lot of your practice right now is around debt resolution, or is it more on the mortgage stuff?
So I don't
Or is
use
it
the term
pretty
debt
good mix?
resolution because that's kind of a different industry that's not. But what we
So
do
it's
is
not bankruptcy. It's basically
No.
debt collection issues, right?
So we fight abusive debt collectors, and we
Okay.
fight abusive debt collections, and then we help people overcome mortgage problems like foreclosures and things like that. Misstatements and other loan modification failures. One of the examples that you asked for earlier, I was going to talk about the fact that loan servicers will mess up the modification. They'll say you're approved, and then they won't honor it. And so you're making these trial payments, or you're making the payments in what you think is a modification, and suddenly you get a notice, oh, you're behind. Well, wait a minute, I've been paying as you told me to. And that can happen for months or years, and then all of a sudden you get this foreclosure notice, and you're, wait a minute, what do you mean I'm behind? I was paying exactly what you told me to pay. And that is shockingly common, especially coming out of the pandemic, because the loan servicers were so overwhelmed with the numbers, and they just never put the right procedures in place, and they never had the staff to do them properly. And so we see that a lot as well.
I can tell you back when one of my mortgage servicers, at one point, I actually refinanced to get away from them. But I had signed up for auto payments and we're making biweekly payments. Well, the servicer lost the payments. They couldn't find my payments. And so they actually reported me late on the credit bureau on the mortgage, and I had made the payments. I had proof that I made the payments, but they were actually reporting me late. I think eventually I got it off, but it was a climb to get that off. And then I refinanced to get away from them, which not everyone would probably think to do, and there's some costs associated
Might not be
with
able
that.
to,
Yeah,
right?
especially with these higher rates.
Right. Yeah. But here's the thing. I mean, there's definitely got to be recourse you could take against that bank, right?
Well, absolutely. I mean, there are lots of federal laws in place that protect borrowers in the case of mortgage lending, because you don't get to pick your mortgage servicer.
Right.
I mean, you pick who you borrow from, but when they sell the loan, you're stuck with whoever they handle to manage the loan.
Right.
So if you're dealing with a company like NationStar, or you're dealing with who else is out there now? Actually, NationStar just bought up like half the market. But
there's a ton of them.
SPS, SLS, I deal with a lot of times. So there's a bunch of different mortgage servicers, and if you're dealing with one that is not on the ball, you might be finding yourself in a problem, just like you found.
Yeah.
So.
Yeah, we were lucky. We were able to get away from them, eventually get away from the mortgage, but not everyone has the resources to do that. And everything is so expensive now. I think that's the problem, is inflation is just out of control.
I took my insurance out of escrow for that type
Yeah,
of reason,
I don't escrow
right? I don't like
at
it.
all,
I can
ever.
handle it myself.
Yep.
It doesn't matter. And then my monthly payment is essentially the
never
same.
changes.
It never really
No,
changes.
not essentially. It is the same.
You
It
know.
doesn't
And you're lucky
change.
that you're able to do that because a lot of lenders don't give permission. Or I did have a case one time where a lender did give permission and then they didn't honor it.
Well, they have to have 20% equity
Right.
per their servicing rules to be able to do that.
Right.
And then I don't think FHA and VA, I don't know if you have the option. If
I don't
you've got
think you
that
do.
loan.
But
I don't think so.
I don't think so either.
I put a lot more,
Yeah, I
put
don't
enough
know, but
down,
I think the answer is no.
Yeah, but it's.
I know on conventional is 20% down.
Well, then it's easier. I just put it on a credit card. I get the points,
Oh my
pay it off
gosh.
right away, and I don't have, I don't have to worry about anything.
There you go. Free trips.
Right? Yeah. It's,
That scares the heck out of me because most people are not going to do that. They're not going to do the pay it off right away.
oh, I don't even wait to get the statement. I'm just like, every Friday I'm like, let's
So
make
you
sure
put it on there
just
and then
make
you
sure
pay
to
it
have
off.
it at 0 all the time.
Yeah. I mean, the challenge is whether your lender saves it or you save it. Either way, it's got to be saved,
Right.
So one of the things, we see it a lot in new construction, where the lender will estimate how much the payment is with the full insurance and the full taxes. And then essentially the next year when they reassess the escrow, they have too much money in there, so they have to give it back to them. But they've assessed on land. And so they have this yin-yang in their escrow for 2 years.
Yeah.
And I tell people, keep making that same payment to yourself. Like, if your loan was $3,000 and now they're saying it's $2,300, put
Save
that
that
extra
money.
money aside
Save that
because
money.
it will adjust.
Or keep paying the $3,000 and it goes off
No,
of the.
you can't. They won't
No,
take it.
because it doesn't go into escrow then.
They won't take
It
it. They
goes to
can't.
principal instead.
Right,
Yeah.
but why wouldn't you just want it to go to the principal anyways?
Yeah.
Because you're
No, because then your escrow is going to be short.
I
you
see.
want to be able
That's
to make
the
up the
point.
escrow short.
I see.
Yeah.
Okay.
Yeah. Put in a savings
I was
account
like,
to
just
yourself.
work on the principal.
No,
Come
no,
on,
no,
pay
no,
it
no.
off early.
Put it in a high yield savings.
It doesn't.
account.
That's
Right.
the answer. Put in a high
Yeah.
yield savings. Yeah. All right. This is Tampa Home Talk. Our hour is
Man, that
already
went quick.
over. I know it did.
You'll have to come back, Mike.
Mike,
We barely
thanks
put
for
the toe in
joining
the
us.
water.
It's so great
It's
to
been fun.
see you,
Yeah.
and it's great to have you back on the show again. If you have any questions and you got some debt collectors that are not treating you right and you think they're breaking the rules, call or text us. We'll get you connected with Mike, 813-377-2775, 813-377-2775. This is Tampa Home Talk. I'm your host, Katrina Madewell. We'll be back next week. Love where you live, or we're going to fix it. Welcome home.
Love where you live, or my mommy will fix it. And we're out.